Earnings season started this week but got really interested yesterday with Delta and today with bank stocks, as we can see that helps us know a little bit more about the economy. Hello everyone, welcome back to the channel. Today we're going to talk about the three banks that reported earnings today. How did they do? What did they report? What they're telling us about the economy and more. If you're new to my channel, welcome. Please consider subscribing and smashing that like button since it really helps the channel out. Now, if any of you are interested in me talking about Delta or any of the other airlines, let me know in the comment section below. Now, first of all, we can see that first the S&P 500 today is actually flat. It's at 0.0% at the moment, but in the past week is up 0.08%, in the past month 0.54%. The Dow Jones is actually down today 0.57%, and the past 5 days 0.86%, but the Nasdaq is surprisingly up 0.50% today and actually up 0.88% in the past 5 days. But we can see that many people are worried at the moment because we can see that since its peak the Nasdaq is down 7.2%, but let me tell you that I'm not that worried right now, but it is definitely something to take into consideration for the coming days and weeks. Now let's start with bank earnings. First, we can see here that Wells Fargo fourth quarter revenue tops estimate profit jumps, which this is something that really excites me because I don't invest in Wells Fargo anymore, but I used to in 2020, and I have to say that it was one of the investments that no one liked in my channel because Wells Fargo was one of the worst banks at the moment because it was the one getting most affected for different reasons and many problems that they were getting into, plus all the problems that they have been having since 2015, 2017 because of all the double account issue that they have been having. But let me tell you that I started investing in this company first of all because of their dividend, but second because I saw the potential in this company that I knew they were getting really affected, but they announced a new CEO and the new plans that they had for the future, and I knew, or I believed at the moment, because it was impossible for me to know, but I believed at the moment that they were going to be able to improve, get out of those problems and see growth again, and that's why they have been saying lately. So we can see that the profit jumps because Wells Fargo on Friday they reported earnings per share of $1.25 versus the $1.13 expected, and in revenue they posted $20.85 billion, topping consensus estimate of $18.8 billion, and the net income increased massively 86% to $5.75 billion. But we do have to take into consideration that results were held by $875 million reserve releases that the bank had set aside during the pandemic to safeguard against widespread loan losses. As remember that banks last year and in 2020 reserved some money or a lot of money in case of losses, but because the economy has been recovering for the whole 2021 and now 2022, banks have been releasing this amount of money, and that have been helping to their profits. Now, as the economy continued to recover, we saw an increase in consumer spending, higher investment banking fees, higher asset-based fees in our wealth and investment management business, and strong equity gains in our affiliate venture capital and private equity business, which obviously is great news for Wells Fargo. And then they continue to manage credit well, and the strong economic environment helped reduce charge-off to historical lows, and our results benefited from reduction in our allowance for credit losses, which is what I was talking minutes ago. Now, the fourth biggest US bank, which is Wells Fargo, by asset is considered by analysts to be one of the best places for a rising interest rate environment because of its vast retail banking network and large deposit base. Rising interest rates allow banks to charge more for loans, flattening their profit margins, because obviously one of the most benefited companies from interest rates going up are banks, because we know that their profits or revenue have been decreasing since 2020 when interest rates were lower, and now that they're expected to go up, banks are the ones that will get way more benefited from this, while other companies get really affected from this, because this means that people will need to pay more for their loans, their mortgages, their auto loans and more, while companies need to pay more. So those companies that need to pay more for loans are going to get affected by this interest rates going up, but banks are gonna get benefited by it. Now we can see that certainly Wells Fargo was getting really affected as a stock and a company in the past 5 years, as we can see that since January 2017 until January 2020 it was down 13.13%. So that was 3 years on a downturn, and now it is finally up 5.14%, which is obviously not that much, but after this huge drop they saw in 2020 because of the pandemic and everything, the stock is actually up 169%. And in my opinion, I believe that in the long term, Wells Fargo will do really, really well, as we can see that it was getting really affected because of all the problems that they were into that I mentioned at the beginning. But now that they have been improving and solving those kind of problems, the company and the stock have been improving as well. Now, the second bank that reported earnings was Citigroup, which profit drops on higher expenses, consumer banking weakness, which obviously is a little bit misleading or confusing because we see that Wells Fargo profits actually jumped, but then we see Citigroup that profits drops on higher expenses and also consumers banking weakness. Now, Citigroup shares slide after fourth quarter profit declines 26%. As we can see, they reported earnings per share of $1.46 versus $1.38 expected, and revenue 17 billion versus $16.75 billion, which obviously is very nice that they were able to beat analyst expectations, but still they saw a drop of 26% to $3.2 billion in net income. Citigroup cited an increase in expenses for the sharp decline, adding that the results included pre-tax impact of about $1.2 billion related to the sale of its consumer banking business in Asia, meaning that even though the headline of these articles are that the profits are declining, that Citigroup, it makes it look like Citigroup's in problem, is actually because of their consumer banking business in Asia that they sold it. So it should be a short-term effect. Now, the company global consumer banking business saw a revenue decline as well of 6% year over year to $6.94 billion, which obviously that is not good. Within the North America region, Citigroup revenue fell by 6% to $4.4 billion. And in Asia, revenue dropped by 9% as well. Expenses within the bank's global banking division also surged by 33% year over year. Had to exit less profitable parts of the firm global empire. Her first major strategic move was to leave the 13 retail market across Asia and Europe. Since that April announcement, she has disclosed plans to depart South Korea and Mexico. That's when Jace Fraser took over for predecessor Michael Corbat a year ago. Her mandate was to improve returns at the third biggest US bank by assets, and that's what she's trying to do with the company by selling this Asia market. Now, another of the reasons of why their expenses have been increasing a lot is because costs have also risen due to a battle for talent on Wall Street that has prompted global banks to offer perks like higher pay and bonuses. They have seen some pressure in what one has to pay to attract talent. So obviously that is a wage inflation that have been going around in the US since last year, as companies need to pay more basically to attract new employees and actually to maintain the ones that they have, because of all the competition that is currently in companies. And we can see that banks are not an exception here. Now that we can see that the stock is actually up 19% in the past 5 days, in the past 5 years, sorry. In the past year is down 3.19%. Now, JP Morgan also reported earnings today, and the shares fall after 6% after CFO lowered guidance on headwinds, including wage inflation, which is what I was just mentioning with Citigroup. But still, we can see that they reported a revenue of $30.35 billion versus $29.2 billion expected, and earnings per share of $3.33 a share versus estimate of 3.01. So they were able to beat analyst expectations, but still they have been having problems as well, as we can see that they had to lower the guidance, which we didn't see that with Wells Fargo. They also had higher than expenses that drove a 14% decline in fourth quarter profit to $10.4 billion, while their revenue was nearly unchanged at $30.35 billion in JP Morgan. That it took $1.8 billion net benefit from releasing reserve for loan losses that never materialized. Now, shares of the bank dropped 6.2%, but we have to take into consideration that over the next 1 to 2 years, they expect to earn modestly below that target as the headwinds likely exceed that tailwinds. They are expecting higher expenses in the short term in the next 1 to 2 years as Wall Street revenue to cost the company's returns to dip from recent years. Now, and just like with Citigroup, they were asked if a tight labor market was forcing JP Morgan to pay its personnel more, and they answered that it is definitely true that labor markets are tight, that there's a little bit more of labor inflation, and it's important for them to attract and retain the best talent and pay competitively according to performance, which means that this is going to be a money game. Whichever company has more money is the ones that are going to attract and retain more of their personnel, as they need to pay more in order to attract more employees and to maintain the ones that they have, because the pandemic taught us that we need to improve life and we need to enjoy life. And if I'm working in JP Morgan, let's say, and I'm not happy with it because I'm earning $20 an hour, but in Citibank they're paying me $30 an hour, I would prefer to move to Citibank, maybe. So that's what they are competing at the moment, and that will affect some companies and benefit others. And most likely the ones that are gonna get benefited are the ones with most money. Now, we can see that JP Morgan stock is actually up 88.43% in the past 5 years, and in the past 5 days is actually down 6.75%, and we can see this huge drop after earning 6.26% today. Now, big banks ready themselves for Fed rate hikes, which could be good and bad. It could be bad because FICC was a bright spot for the banks during the depth of the pandemic, but the good times for trading appear to be fading with Fed normalizing nearing. As we know that during the pandemic, all banks were getting benefit from this, but because of everything that's going on and interest rates intended to go up in the coming months, banks are going to get negatively affected as well. But in the bright side, although the Fed policy shift took some steam out of the FICC trading, analysts say banks should benefit from higher rates as well, because as I said in the beginning, while interest rates go higher, banks will be able to charge more on interest for your mortgage, car loans, personal loans, and more, and even student loans. So that's obviously the way that they will be able to both increase their revenue and their net income. Now, I do have to say that currently I don't invest in any bank stock. I used to invest in Wells Fargo. I made some profit with it. I sold it. I never looked back, because one of the reasons that I started investing in that company was because of their high dividend yield, which they had to stop during 2020. If I'm not mistaken, it was the only bank that had to stop their dividends. But after that, I saw the potential in the bank because of everything that I mentioned at the beginning, all the problems that they were having, but I knew, or I believed, that they were going to solve and the stock was going to get momentum as well. But I sold for a profit and never looked back, and right now I'm looking to add banks to my N1 Finance portfolio, which is the ones that I've been showing lately in the past 2 months. As you guys know, that portfolio is mostly funds and tech, so I want to diversify a little bit more into banks, maybe because I believe that bank stock and the banks will really benefit from interest rates going up, while I have other companies that will get negatively affected by interest rates going up. So it will be kind of a balance. I don't invest in any of them right now. I will do more research, as you guys know that I like Wells Fargo, but I will do research on JP Morgan, Chase, on JP Morgan, Citigroup, and Wells Fargo, and Bank of America as well, to see which one is the best one, or even not only those 4 banks, as they are the biggest banks in the US, maybe other smaller banks as well. Not fintech, as I already invest in fintech, but I want to invest in banks, in the financial industry this time, because of their dividends and their potential with interest rates. Now, would like to know what you believe about bank earnings, if you invest in any of them, and why. Thank you, and see you next time.